Do you want to be a successful trader? In long term, do you want to become a profitable trader? Then there are some strategies that you have to master in. One of those strategies is trading the divergence. If you master the strategy of trading the classic divergence or the hidden divergence, I assure you that in long term, you will surely be a successful trader. Hi, friends. Professor Joe here. I hope you all are doing great and welcome to another video in learning different strategies in trading. In this video, we are going to cover about divergence, the bullish classic divergence. So let us see what are the key areas that you have to look into before entering into a trade using bullish classic divergence. Now traders, there are four type of divergence. Two is the classic divergence and two is the hidden divergence. The classic divergence are found on the top of the charts and in the bottom of the charts. Today, we are going to understand the details about a bullish classic divergence. So let us look at all the different confluence that should happen while entering into a bullish classic divergence. This is the setup how a bullish classic divergence should look like. So you can see that the price is making lower lows and you can see that the corresponding technical tool is making a higher low. So let us break this up into small parts so that you understand when a perfect classic divergence is getting created. Now remember, here we are discussing bullish classic divergence. So first you have to look for a long-term trend support zone. So step one, in long term, the price should be at a good support zone. At that particular support zone, in the current time frame, the price has to be making lower lows. So in the current time frame, you will feel that the market is in a downtrend. But in the higher time frame, you know that the market is in an uptrend and it is going to reach a good support zone. The current time frame. So when you're looking at current time frame and a higher time frame, you can look at. So if you're trading with a 15 minutes chart, the higher time frame could be a 1 hour chart. If you're trading with a 1 hour chart, your higher time frame could be a 1 day chart. Okay. So let us take an example of 1 hour and 1 day. So in 1 day chart, you see that the price is coming close to a support zone. But in the 1 hour chart, if you're only looking at the 1 hour chart, you will see that the price is coming down in a downtrend, but it is making new lows. At the same time, the corresponding technical analysis, in this case, it's an RSI, it is making higher lows. That means the price is making lower low and the RSI is making higher lows. So here there is a conflict, there is a divergence. The price is showing something else and the corresponding technical tool is showing the opposite. Now you have identified a classic bullish divergence, but when do you enter? So in the current time frame, which is the 1 hour chart we are discussing, you will see that the price will break the trend line. So now there are three approaches to enter. Approach number one is when the price breaks the trend line and the price closes above the trend line, you can enter. Second is you wait for the price to go to make a high, come back to the second support zone. That means there's a earlier support zone and then there is a next support zone. The second support zone. So at that particular price, you can enter. Or third is you enter at the breakout of the new high that has been created after the breakout of the trend line. So you have three approaches. One is an aggressive approach and one is a breakout approach or a pullback approach. So there are three approaches with which you can enter a classic divergence for a trade. So now let us look back at the chart whether all these conditions that we have discussed is being met. Now this drawing is something that has been created. It is not from a chart, but it is a simulation to help you understand that how the price should be moving in two different time frames. So now in this case, we can see two time frames. One is the higher time frame and one is the time frame in which you are trading. So we said that we'll take an example. The time frame that you're trading is a 1 hour time frame and the higher time frame is a 1 day time frame. So in the lower one, the higher time frame, that is a 1 day time frame, you can see that the price has broken the previous resistance and then it has come back to the previous resistance, which has now become a support. Now that is the area where you have to look for a classic divergence. So the blue line is a support zone in the 1 day chart. Now let us go to a 1 hour chart. In the 1 hour chart, you can see that the price is making lower lows. And you can see that the technical tool, that is RSI, is making higher low. After that, you see that the price, after that, the first indication is the price is breaking the trend line. So you see point number one, that is an aggressive entry point, wherein as soon as the price breaks the trend line and the price closes above the trend line, you enter into a trade. The second is you wait for the price to retrace back to the second support zone. So there is a main support zone and then there is a next support zone. In this drawing, you can see that the blue line is the next support zone. So when the price reaches that support zone, and you can look at candlestick patterns, okay? So if you see a good candlestick pattern over there, you can enter over there. So that is called a classic divergence entry, but using the pullback strategy. So within classic divergence, in a lower time frame, you're looking at the pullback strategy. And the third entry point is more safer, wherein you are entering at the breakout of the resistance. So you can see point number 3, it is breaking the resistance. So when the price breaks the resistance and closes above the resistance, that is when you will enter. So there are 3 entry points. Entry point number 1 is breakout of the trend line. Entry point number 2 is at the support zone. And entry point number 3 is the breakout of the previous resistance. So you got 3 entry points. You can use either of these entries. It is always better to be more safe. That is, go for the breakout of the second resistance. Okay, that way you are very safe that the price has changed its direction. Now, as I always say, there is no strategy that is foolproof. So this trade can also go wrong. So when you are infusing, do not infuse more than 2%. I always say start with 0.5 when you are learning to trade, or 1%. Maximum is 2%. For a stop loss, you can use 2 of the tools. One is the ATR. ATR is average true range. So you're looking at the average movement of the market of that particular financial instrument, and 1.5 times or maybe 2 times of the ATR, you can put your stop loss. Second way is putting the stop loss below the support zone. Now you don't have to put the stop loss below the bigger support zone. It has to be below the new support zone. That way your stop loss will not be too wide. Okay, it will be a decent support zone. So when you're taking a risk to reward, it can be 1:2, 1:3. This way you can make better profits while you're trading. So after the simulation, if you look at the real chart, so this is a picture of a real chart. You can see that in this particular screenshot, all the details that we have discussed is clearly seen, except for the long-term support zone. Other than that, everything is clear in this. So this is how you're going to identify a classic bullish divergence. I hope that this explanation has made it clear how to identify a classic bullish divergence and how to enter. Now, if you want me to explain a classic bearish divergence, please comment. I will go through the comments, and if somebody has asked for it, I will create another video on that too. So in summary, in this video, we have discussed the different kinds of divergence. So there are basically 2 types of divergence. One is the classic divergence and the second one is the hidden divergence. Classic divergence on tops and bottoms, hidden divergence during the trend. Next, we discussed what are the confluence that should be there while you are looking for a proper classic bullish divergence. Next, we discussed how much you have to infuse and how you have to put your stop loss. Finally, friends, trading is all about practice, patience, and persistence. If you really want to be a successful trader, these 3 things are important: practice, patience, and persistence. And the next important thing is learning to take small losses. So if you see a good setup, you enter into a trade, but you apply a stop loss. So if you are wrong, the stop loss will be hit. And if you're infused, say 0.5%, you still have 99.5% equity left to enter into your next trade. This way, with practice, you will become a better trader and you'll become a successful trader. Now, friends, I have written a book on trading. Traders, you can win, but first learn to lose. This book is all about understanding that don't take big losses. Learn to take small losses, learn to spend time in the market so that when you learn trading properly out of your experience, you will be able to take bigger profits. In this book, I have explained two strategies, the pullback strategy and the breakout strategy, and what are the confluence of indicators that you have to look at. Finally, friends, if you love the content that I'm creating, please like and share these videos so that people who are trying to learn trading or are confused about some parts in trading, they will learn something new from this. If you want to learn more about banking, investment banking, trading, Forex, please subscribe to this channel so that whenever I create a new video, you will be the first person who will be notified about the video. Last but not the least, I would like to tell everybody is keep learning, keep growing. Thank you. Namaskar.